continue our discussion on the various kinds of investments and asset classes that are available. And we're going to look at specifically debt now. Now that we're done with equities, we're going to look at the asset class of debt, which is essentially how do we invest in bonds? What are the various agencies that issue bonds? What kind of bonds are available? And while some of this will recap a little bit of what we have already covered under financial management, we are going to look at a few new things about how debts work and how debt instruments work and how what kind of risk and reward structure do they provide to us, right? So now the first question is, what is debt? The connotation of debt is usually negative. We believe it's a burden, but in this particular case, as investors, we are not the guys who are borrowing, but we are guys who are lending. Remember, we are essentially buying bonds, and a bond buyer is the lender, the bond issuer is the borrower, right? So we are buying bonds. And why are we buying bonds? Is because we will get some interest income on that, and there is a possibility that we could also get what is called as a capital appreciation, right? Why can capital appreciate? If the bond prices go up, for example, right? So the question is, how can bond prices go up? So how do bond prices go up? That's what our key construct is in terms of investing in bonds. Some part of the income is fixed, it's going to come to us. Some part of the income is if the bond prices go up, right? So that's the broad idea. Let's quickly recap what we have already learned under some of our other subjects as to some key terminologies with respect to the bond markets and bonds. Face value is the value at which the bond will be redeemed, which is nothing but the principal amount at the end that will come up, right? It's not the value at which the bond is issued. Issue price could be the same as face value, or it could be something else, right? So for example, if there is a bond that's priced at rupees 1000, it is quite possible that when it goes to the market, the issue price is not 1000 but maybe is 1020, is because there is a bigger demand for buying this particular bond, right? But the face value will be 1000, right? Because that's what is assumed as the principal, and you will receive that at the end of the tenure of the particular bond, right? The term that is one part of our income is called the coupon rate, which is also what is the interest that is defined, the fixed interest defined. Coupon rate is typically as a percentage of the face value. So if the coupon rate is 8% on this 1000, we're talking about 80 as the coupon, right? So the interest rate that will be paid to the investor on a frequent basis, whatever that frequency is defined as the coupon frequency. Now that could be yearly, that could be half yearly, that could be quarterly, that could be monthly. The frequency at which the coupon is paid is basically called as the coupon frequency. Then we look at what is the maturity or tenor, which is the period after which the face value will be returned, or basically the bond life. You know, what is the life of the bond, what is the duration, the total term for which the bond is outstanding. In other words, the period for which we have basically lent the money, right? And then if the bond is trading in the market, what is the current price of the bond? If the security is listed, the last traded price of the bond, it could be different from the face value and the issue price, right? There is a fair possibility that this current price is different from the face value and issue price. So that's basically a quick recap of the key terminologies that we remember. Remember, coupon rate is the fixed payment that you will get every year, and that's why these instruments are also known as fixed income instruments, if you remember, right? Now, so broadly, that's the key terminologies. Now, the debt products that you could look at, the various kinds of debt products are available, could be direct bonds. Bonds could be issued by government. Bonds could be issued by corporate, right? They could also be issued by banks. Banks are kinds of corporate, so we could basically say that bonds would be issued either by government or government agencies and by companies, right? Then you could have mutual funds, which are funds that will invest in bonds, right? So these funds invest in bonds. So these are going to invest in bonds, and these are called as debt mutual funds. There are a variety